Today we're going to go over real life situations that's happening out in our current market, which is properties that people have that they have to do something with. They have to get out of their loan. They have to get a flip to a rental. They have a property that's either non-cash flowing or it's negative cash flowing. Either way, what the property's bringing in cannot cover what the mortgage payment is, but what do they do? We've done another video showing why it's better to take a small loss and get something refinanced into a loan and get it rented than just keep making those payments over and over and over. Every time you make a $2,000 to $3,000 or $4,000 payment in interest every month, it just evaporates, it goes away. If you have a property and it's not cash flowing, doesn't have tenants in it, or it's negative cash flow, maybe you're only bringing in $1,500 and the mortgages are going to be $2,000. It's still over time better to lose $500 a month for a year, that's $6,000, than $2,000 a month in a mortgage. That adds up in 3 months. You spread that out more. So today we're just going to go over the options. What are the loans that are out there? What can you use? What do we help people with? What do we advise them to do when they have a property in this market that is not cash flowing? What kind of properties are we seeing that this is focused on or what they need? There's a lot of flips people got into. They look like a great deal 6 or 8 months ago. Now they're just not working. So there's two things. We just did a video on maybe doing a short on that, but other people just want to keep it as a rental because they anticipate in 2 to 3 years the markets will be back and they can recoup what they have into it. If you're looking for a non-cash flowing, typically it's something like this. It's a flip that needs to be put into a rental and the rents are not going to cover it, or you don't have it rented yet, so there's really no rental income coming in. Or there's people out there who just want to lock in a rate, even though that rate is higher than what they could have got 6 or 7 months ago. They just want to know now because they don't know if next year it's going to go up 2%, 3%. Heck, some people say 4 or 5%. They want to know. They want to know exactly what they're going to get into now, get some certainty, because next year could even be worse as far as the properties that you have that are not locked in. Buying next year is going to be a great opportunity, but having properties right now that have no certainty to them is probably what people are looking for too. Another thing we're helping people with, and we're seeing it more and more, people who have real estate, purchase real estate, and they're putting money either back into their investment business or just their business. We just helped a person get $150,000 to accelerate his consulting business. Another guy who needed $200,000 out to help his construction business. All those kind of deals too, when one was a piece of land, so there's no cash flow coming out of that, and another one was a house that just had very limited income, but the equity was there. There's one other thing that's starting right now, and it'll actually start climbing. You'll see more and more of it where banks and lenders, maybe you're in a 3, 5, or 7 year fixed, those are coming due, and the banks are not going to go through and honor or extend those, and they're going to do what a call and just say, hey, you have to pay us off or you have to pay us down. We're seeing more and more banks tightening. That's just part of the market. When the Fed keeps raising rates, the banks are going to tighten their box. Higher credit scores, lower loan to values, get rid of some of the stuff that maybe is on the non-cash flowing side. They want cash flowing things. Lenders and banks are going to either start turning them down or not extending them when they come mature. And this is where you're going to have to look at options for that. And then we're talking about different properties. We are talking about a wide variety from single families to small apartment buildings, mixed use, even small commercial. So the majority of these loans work in any of these situations. There's also 2 ways to look at this. Some people are looking at this as like, how do I get some certainty for the next 2 or 3 years? And some people are like, lock me in for 30 years. And we just want to go through the options that you have right now, because the mortgage industry is changing every day. Options are changing every day, and it's usually not in the benefit of anybody borrowing money. Credit score requirements are going up, loan to values are going down, and rates are going up. Let's go over the most common options you have for these non-cash flowing properties. First of all, you still can get into a traditional loan. That means like a 30-year fix for Fannie and Freddie, or even a bank product. Because if you're starting now and getting a 3 or 5 or 7 year from a bank, that still would probably get you past what we anticipate for the market downturn before rates start getting a little bit better and better. You can still get a traditional loan, or from a bank. We're also going to go over bridge loans, and that's just a 1 to 2 year loan that you could get into, and we're going to go through why you would do that, the different requirements, all those things. So you can probably take some notes, make sure you understand where you fit and where your property fits into this little matrix. And then also DSCR loans, the rental payment kind of loans. And this is a DSCR loan that does not go off of your current rents. It could go off the market rents, or it could go off just no rents at all based on just what the property may rent for. First thing you have to think about is credit. Credit in the lending industry is just like you, if you have a rental property, thinking about your tenant. What do you want that tenant to look like? Do you want them to pay their bills on time? Is that what you're looking for? Lenders are looking for the same thing when they're looking for borrowers, especially in these times when things are tightened up. So the credit has gone up in every one of these. You need 680 and above in almost every category. It does not matter where you're at, what you're looking at, unless it's like a private loan out there from someone else. Credit in this market is something you have to work on and make sure you're at 680 or in the mid 700s. That will get you the better terms. Next is income. The reason you could get into a traditional loan or bank loan is even if the property is not cash flowing or it's negatively cash flowing, if you have the strength, if you have the ability with the job you have or the other income from other properties, you can still get a traditional loan, but this income is based on you and your ability other than this property. The property could bring in nothing as long as you have the extra income in your life, in your business to cover that. Bridge loans and DSCR loans, both of these in this particular property don't really rely on income at all. So here, if you don't have the income, if your business doesn't have the income, we already know the property doesn't have the income, you're probably looking at a bridge or a DSCR loan to get into something like that. We put this information out there because this is what we're hearing from other people. If this is helpful to you, give us a thumbs up, like this video. It helps us, it helps others. Also now term, what does that look like? What makes you feel comfortable? If you're working with a bank, the bank terms are typically, somewhere between a 3 to 7 year fixed period. It could be amortized over 20 or 30, but it's only fixed for 3 to 7. That kind of bridge will probably get you over into the next season where rates come down. If it's a traditional loan, then you're talking 30 years. Loan to values. Loan to values when you're talking about non-income based properties, if you qualify, you're still going to hit your top, which is typically 75%. This will probably get you the best LTV, loan to value of any properties, because if you qualify yourself, they don't really care about that and they're not going to hit you on the LTVs. Now, as you go down the bridge and DSCR, what you're going to find is typically a bridge loan is 1 to 2 years. If you have an exit in 1 to 2 years, this is great because it's easy, it's fast, it's something you can get into in a week or two. But the loan to values probably are usually 60 to 70% max. So it's somewhere there. So we're losing some loan to value as we go down too, because you got to remember, lenders are looking at it, no cash flow, maybe no income from you. Our safety is in this property, so we're going to have a lower loan to value. The DSCR loans with the no cash flow, they go all the way out to 30 years, but they do have other products like interest only, 40-year, 3, 5, and 7-year fixed. But they can go, traditionally 30 years. The loan to values when there is no income on the property does take a hit, and you're usually looking at somewhere between 65 and 70%. Over a traditional DSCR where it's rented and everything, you could get up to 80 and sometimes even 85%. If you have a property and you're looking at least getting some certainty in there, getting a loan on there, these are going to be your options. And it just depends on where you fit in here. And the biggest one is the income. If you qualify, banks, traditional loans, they're still better than getting into the bridge or DSCR. If you have a question, you could reach out to us. We could go through the numbers with you. We could see if we could help you. We could maybe even refer you if we cannot help you. As always, happy investing is profitable investing.